Welcome to Voice of India and our show, The Real Estate Secrets. Today's session is on tax on rental properties, and we have with us today Mr. Jagjit Singh, who is the owner of company The Vector Advisors, which deals with tax on rental properties and tax consulting and bookkeeping. So, welcome to the show, Mr. Jagjit Singh.
Thank you.
So we all have wish of buying rental properties, and people are buying lots of rental properties today. So, but at the same time, when we have to deal with the tax, so please let us know how we can save taxes and while buying the rental properties, and what expenses we can claim.
Yeah, when we going to buy a rental property and claim those income, right? So first thing in our mind is what kind of expenses we can claim on those rental properties. So if when you're going to claim it, first is mortgage interest. You're going to claim it, and then mortgage interest, then utilities. Utility, if you are paying that, then you can claim it. If your tenant paying that, you can't claim it. Then property insurance, property taxes, and if you're hiring any management company, some people do that, so you can claim those expenses also. And any renovation, any kind of additional you did to rental property, you can claim that also. Yeah. And then after that, there's a one depreciation on the property. That's capital cost allowance we can talk about.
Okay.
That you can use that, you can claim it on your taxes. It's on depend. It's a flexible in nature. So what you can do, like what we suggest, let's say, just to give you example, that somebody has a rental property and he has his personal income also, and if he has a high tax bracket this year, so we claim those depreciation on this year. If he is not falling in high tax bracket, we suggest them to keep that so he can use it in further years. So it's a flexible in nature.
Means the person who are employed, like employees, right? Not self-employed.
It's all depend if he's employee or self-employed, right? If he is personally, his income is in high tax bracket, and with that, if his rental income is addition to that, and then it becomes a high, it comes to his income in a high tax bracket. So
Okay.
you can save that taxes with claim those depreciation on the properties,
Okay.
right? But it's not like all the other claims. You can use, you have to claim that in that particular year. But depreciation is capital cost allowance, as you can use that for further years. You can save it. It's a flexible in nature.
Means we can claim every year.
Not every year. You can claim it next year. Like this year, you don't have much
Okay.
income,
Okay.
so you don't need to claim it. But next year, you have more income, which you become in a high tax bracket. So you can use that. You can claim that on next year also. Yeah.
Okay. So another big question is like, like whether to buy the property on personal name or on a corporation. What do you suggest?
Yeah, it's all depend upon your personal scenario. So what we suggest, it's a before that you have to know why the people go for corporation. So in personal, your tax bracket starts from like taxable income starts from like 25% average, right?
Okay. Yeah.
In the corporation income, it start with 10% taxes on your personal on corporation income.
Okay.
To save that, right? So we go for corporation, but this rental income is a passive income.
Okay.
If we get this income in corporation, it's it because of its passive income, it comes in with high tax bracket. So you're paying more in corporation, right? So in
So,
so
like
personal,
in this case, we are paying more in case if we claim it in a corporation like that.
yeah. So the thing is that because it's a passive income, it will be active income if you hire, at least you have enough properties, so you can hire at least 5 people, 5 employees to manage that properties. Then it becomes a uh, makes this rental income into a active income. That then you can your tax bracket, it comes to like 10%. Then you can save taxes if you have not enough properties, right? And if you have like a few properties which you don't need to manage, hire somebody to manage those ones, then it comes with it goes to like you have to pay more taxes on it as a passive income. So if you buy in a personal name, right? If you are already in high tax bracket, like let's say, just gives you an example. If you're if you have a very good as a manager, working as a manager somewhere, right? Good income, and you buy another property, and then on your personal name, and you're already in high tax bracket, and with that rental income you are paying more taxes on that. So let's say um, you buy like 3 or 4 duplex, right, which gives you more income. Then you have to pay more taxes if you are getting all everything on your personal name. So then you can go with the corporation. So in that corporation, what happens, you can split with your shareholders, like your family members, right? If you there in shareholder, you can split their income. So everybody has their own tax bracket. So everybody has to pay their own taxes. So that's how you can split the income. Yeah.
Does it also depends upon the family income? Like it does has to do anything with this or?
No, it's a personal, because if you're going to buy, if a shareholder is um, like if we take a scenario like 50-year-old someone, right, and he has a family, kids who is not depend on him, they're independent, right?
Okay.
They have their own income tax bracket and everything. Then it's not a family income.
Okay.
Yeah. So, but you have to be careful with the tax term, like tax rule is TOSI.
What's
That's
that?
Tax on split income. So you have to be careful with that.
So like,
yeah.
like, so I have to ask a question as a layman. I don't know.
Yeah.
You know,
That's
lot of people. So what's this? Can you please elaborate on this? What is this?
Yeah, it's a high
split?
tax, marginal tax. So if this is the government made this rule because somebody is going to hide their taxes and everything. So this is why the TOSI is there, to if there's a split income. So you have to be careful with that. So we sit with them, suggest them, and see the scenario and let them know this is how you can split your income, so you don't fall on that TOSI rule. Yeah.
Okay. And what happens when we sell the property? Like, do we have any capital gain?
Yeah. So if you buy a property, second property, not the first one. First one is your residential
Principal,
property.
yeah.
Residential property. And then when you buy a second property, so what's gonna happen when you by the time when you're going to sell that one, so you get some gain. So on that gain you have to pay taxes. That's called capital gain.
So let's say we bought a property of 100,000
Yeah.
and we sold it for 150,000.
Yeah.
So we earned 50,000. So how the numbers play there?
Over there, like if you buy it for 100,000 and if you sell this property 150,000, you get a gain of $50,000,
Yeah.
right? So on that $50,000, that's capital gain, and you have to pay 50% of that gain, like 25,000. That means
Okay.
on that will go if it's on personal. So it adds in your personal income, and then you have to pay the taxes on.
25% of that 50,000.
We
Right.
say like 50%, like you can say that.
Means
But
around 12,000, right?
but,
Like that. That's a big amount.
it depends upon your tax bracket. Yeah, but
Okay.
50% of the gaining amount, it's add to your personal income, and then you can get actual tax bracket. Yeah.
Okay. And what happens, like there are different scenarios when, you know, like I've seen a lot of people have tenants in their basements and like so can tenants claim that when they're staying in the basement? Their rent.
If they're getting the receipt, like some it's a very tricky question. I think you can give the answer better, because these are all the properties are residential single family home,
Mm-hmm.
right? This is why you can't claim as, or you can't get the income like second income. So I think this is something Zoni. I think you can tell us better. What's that, right?
Yeah, I think when a tenant wants to claim the rent from, like, when the tenant is living in R1, which is single family rental property, like single family residential property, so it's difficult to claim. So if you really want to claim, then this property has to be legal, uh, uh, duplex, or like R2 zone property, or it should have a legal secondary suite in the basement. Then only the tenants can claim the rent, I think,
Yeah.
right?
Yeah, that's right. Yeah, that's why like the single family home and who rent their basement, they can't get the receipt, and if you can't get the receipt, you can't claim that.
And I've seen some people like giving cash receipts. Like, is it a complicated thing or?
Uh, Cash receipt, like in the end, if the person is like, if somebody is giving them a receipt, right, it should be add into their income,
Yeah.
right? If he is not adding in his income and somebody is claiming that income, if audit comes in,
Hmm.
because you have to tell them which property you're in
Yeah.
and who's your tenant. If audit comes in, and then there will be a problem if you're not claiming that.
Yeah. So yeah, it has to be properly
Yeah.
like done in the papers. So
It's complete residential suite. It should be like a single family. It's like duplex or triplex. Sometimes six in say, like six suite, independent suite actually. So that one you can living on your own, and that one you can claim on it. Yeah.
and also we have heard about a term, principal home exemption. What's that?
Yeah. So as I said, the first home, whenever you're going to buy that, right? That's your residential home actually. That's not your investment home. So government gives you exemption on that. So when you're going to buy a second property, that's your investment property. On that you are going to earn the income. Residential is for yourself. You're going to live in there. So second property is your investment property. So that second property is first property is residential exemption. So you don't need to, when you're going to sell like a residential property, you buy it for 100,000 and you're going to sell it for 200,000 to move into yours another residential home, right? And you get a gain of 100,000. You don't need to pay any tax on it, and you don't
Okay.
need, it will not.
Oh, that's interesting.
Yeah. So, and there's one more thing. If you buy another property, right, which is you can decide it. Like if you're getting gain from another property more than this your principal home, right? You can declare that this is my residential home. So this is how you can save some money on taxes or for the capital gain also. Yeah. So you can declare it. Yeah.
Well, thank you very much for sharing important information. I hope this would definitely help people to sort out their properties and sort out the taxes and save some money. So stay with us. We'll be soon coming with different shows related to real estate, on rental properties, on home inspections, and you will definitely get value in that. And thank you very much for your time. Thank you for coming, Jagjit Singh ji.
You're welcome.